All right, let's jump into it. We're taking a deep dive today into smart investing, really looking at how to move beyond just, putting your money somewhere.
Yeah, and turning it into more of a focused mission.
Exactly. And the material we're unpacking for this dive, it comes from a really insightful section of a YouTube video. It's titled, Inequal Conservative Aggressive, What Your Risk Profile, Smart Investing Ka, Part 5. That's from the channel Value Vive.
Right, a really interesting source.
So our mission here is to distill the core ideas from this video. Things like understanding your personal investment mindset, setting clear financial goals that actually give your money purpose, and then that really critical step of, actively managing your strategy over time, keeping it on track.
Absolutely. It lays out a powerful framework, really. And the video uses some quite memorable analogies, too, doesn't it?
Yeah, the boat on the sea, tending a garden.
They really help make these potentially complex ideas feel much more, approachable.
They do paint a good picture. So let's kick off with that first major piece, the video highlights. Understanding your risk profile.
Okay, yeah, this is foundational. Think of your risk profile as, it's not just a label, right? It's more a reflection of your whole investment psychology.
Your mindset.
Your mindset, and crucially, your capacity to tolerate risk, which basically means how comfortable are you really with the potential for your investments to go down, maybe even significantly.
In exchange for potentially higher gains down the road.
Exactly, that trade-off.
It makes me think of that boat analogy the video uses straight away. Are you someone who prefers, staying in calm, predictable waters, safety first?
Right, low risk.
Or do you maybe see more opportunity in navigating through, let's say, choppier seas, willing to accept the bumps for maybe a more rewarding destination?
That's a perfect way to put it. And based on this tolerance, this comfort level, the video basically outlines 3 main investor categories.
Okay. Let's start with the most cautious one then, the conservative investor.
Right. So for them, the primary driver is really capital preservation. They're highly sensitive to potential losses. Safety of the initial investment comes way above maximizing returns.
So they'd feel most secure with things like?
Typically, yeah. Fixed deposits, maybe debt funds, government bonds, things where the risk of losing money is very low.
Okay, so safety is absolutely paramount there. What about the middle ground?
That's the moderate investor. And they're seeking, a balance. They want some growth, definitely, but they're not willing to sacrifice security entirely to get it.
A mix.
Yeah, their portfolios often reflect that mix, some equity, some debt. And this is where strategies like SIPs.
Systematic investment plans.
Right, where you invest a fixed amount regularly.
Yeah.
And things like balance funds often fit really well for this type of
We're
investment.
finding that blend, okay? And then at the other end of the spectrum.
That's the aggressive investor. Now, these folks are not really deterred by volatility. They're actively seeking high growth potential. They're comfortable with higher risk assets. Could be direct investments in the share market, equity mutual funds, maybe even crypto for some. They understand that big short-term swings are kind of part of the deal.
For potentially bigger long-term return.
Exactly. That's the goal.
So how does someone actually figure out which of these, really resonates with them? The video gives us some key questions to ask ourselves.
Yes, and this part is so critical because being honest with yourself here really sets the stage for everything else that follows.
Right.
You need to genuinely ask yourself, how would I feel, how would I react if I saw my total investment value drop by, let's say, 20% in just 6 months?
Oof, yeah.
Would you panic? Immediately think about selling? Or would your mindset be more like, okay, this is a temporary dip, I need to stick to my plan?
That gut reaction to a big drop? That's a powerful indicator, isn't it?
Absolutely. And also consider your preference. Do you genuinely prefer the certainty of stable, maybe lower returns? Or are you comfortable chasing potentially much higher returns, even if it means riding out some serious ups and downs?
And your investment horizon matters too, right? How long you're investing for.
Huge factor. Are we talking 1 year, 5 years, or maybe 15, 20 years down the line?
Because the longer the time frame, typically, the more room you might have to recover from those downturns.
Precisely. And the video also touches on some practical stuff, too. Like, do you already have a decent emergency fund set aside? How stable is your income right now? These things affect your capacity to take risks.
Ah, right. Even if your mindset is aggressive, maybe your situation isn't.
Exactly. So the answers to these questions, they aren't just theoretical. They really point towards your true risk profile.
So why is getting this right, like the very first step, why is it so essential?
Well, because knowing your risk profile, it's kind of the non-negotiable first thing you need for figuring out the right asset allocation.
Right, the allocation, like how much goes where.
Exactly. How much you put into shares, how much into, say, bonds or debt funds, maybe some gold, that whole mix.
Ah, okay. So if a conservative person invests like an aggressive one or the other way around, it's just going to feel fundamentally wrong.
Totally. And probably lead to bad decisions made out of fear or maybe even discomfort.
Makes sense.
Yeah, the video really emphasizes this point. It notes that investing based on an allocation that clashes with your real risk profile, well, it's a recipe for stress, for sleepless nights, frankly. It highlights that successful investing isn't just, a math problem. It's deeply tied into understanding and managing your own psychology, your emotions, your behavior. Knowing your profile is the bedrock. It's step one.
Okay, so step one is understanding ourselves as investors. That makes a lot of sense. What does the video say comes next? It feels like you need a destination, right?
You've hit it right there. The next crucial element the video identifies is setting clear financial goals.
Okay.
Right. Think of financial goals as like giving your money a job, a specific purpose. They're the tangible financial face of your actual life dreams.
Like buying a car or a house?
Or funding education, securing your own retirement, whatever it is for you. Goal-based investing transforms putting money away from just this vague idea
into a specific mission. I like that.
Yeah, it provides focus.
That makes so much sense. It's definitely harder to stay disciplined if you don't really know why you're saving. The video breaks these goals down by time frame, doesn't it?
It does. First, you've got short-term goals. These are typically, say, 1 to 3 years out.
Okay, like what?
Could be things like saving for a big vacation, maybe building up that initial emergency fund if you don't have one yet.
Right, that's important.
Or saving for a major purchase like a new appliance, maybe even a bike, things you need relatively soon.
And for these shorter-term goals, the video suggests investments that are generally, safer and more easily accessible.
Exactly. Things like liquid funds, maybe recurring deposits RDs where you contribute regularly.
Like a savings plan.
Sort of, yeah.
Yeah.
Or short-term debt mutual funds.
Yeah.
The priority here isn't high growth. It's more about keeping the capital safe and being able to get it when the goal arrives. Got it. Okay, moving out a bit then.
Yep. Next up are midterm goals. We're talking maybe 3 to 7 years down the road. Examples here could be saving for a car purchase, planning for a wedding, or maybe accumulating capital to start a small business.
And for these, the video mentions things like balanced funds.
Which have that mix of equity and debt.
Mixed CP strategies, and interestingly, it also mentions LIC schemes. Now, it's probably worth noting here, as the video points out, that with any category like LIC schemes, you really need to look closely at the specific product.
Oh, absolutely. Structures, returns, fees, they can vary massively. Whether one fits a midterm goal depends entirely on that specific scheme. Always do your homework.
Good point. It's about the goal time frame first, then finding suitable products. Okay, so what about the really long-term stuff?
Right. Finally, we get to long-term goals. These are defined as, say, 7 years or more into the future. And these are often the big ones, right?
Yeah, buying a house, maybe funding higher education for kids.
And maybe the biggest for many, funding your own retirement. Definitely. And for these long horizons where you've got time for compounding to really work its magic, the video suggests leaning more towards growth-oriented investments.
That's the idea. Things like equity SIPs, long-term instruments like PPF or NPS, or even direct investments in stocks, if that aligns with your risk profile and your knowledge level, of course.
Okay.
Yeah.
So what ties all this together? The goals, the profile?
Well, the critical link the video makes is between these goals, your risk profile that you figured out earlier, and then your actual SIPs and asset allocation plan. Just identifying the goal is the start. The smart planning is what drives it.
And they give some pretty powerful examples to make this concrete, don't they?
They do. Like if your goal is to accumulate, say, 1 lakh in 5 years, and you estimate maybe a 12% annual return, the math suggests you'd need a monthly SEP of around 11,000.
Which breaks it down into something actionable.
Exactly. Or looking further out, that big goal of aiming for 1 crore for retirement in, say, 20 years. Which sounds huge, right?
Yeah, intimidating.
But it might actually be achievable with a disciplined monthly SIP of somewhere between 7,000 and 8,000, assuming a reasonable long-term growth rate. Those numbers suddenly make it feel much more possible.
They really do put it into perspective. And the principle for asset allocation here seems clear. The further away your goal,
the more comfortably you can potentially allocate a higher percentage to equity because you're aiming for that growth potential over the long run.
And the flip side. as a goal gets closer.
Then the video really emphasizes the need to gradually shift your allocation, move towards safer debt investments to protect the money you've worked hard to build up.
Because you definitely don't want a big market downturn right before you need to use that money.
Precisely. Lock in those gains and reduce risk as the deadline approaches.
So the winning formula, as the video calls it, it's really this combination, taking your identified risk profile and marrying it with your clearly defined financial goals.
That's it. That's what enables truly smart planning. It allows you to tailor your SIP amounts and your asset allocation strategy specifically for you.
Right. So a conservative investor aiming for retirement might still have some equity, but maybe a much lower percentage.
Yeah, much lower than an aggressive investor with the exact same long-term goal.
While that aggressive investor, maybe with a 20-year horizon, might go heavy on equity, like 70–80%, maybe even more.
Potentially, yes, depending on their full profile. And the moderate investor, naturally, they'll land somewhere in between, looking for that balanced approach we talked about.
The video really drives this home, saying investing without goals is like setting off on a journey without knowing your destination.
Yeah, you might be busy spending energy and resources, but you won't necessarily end up where you actually intended to go.
Goal-based investing gives you that essential map, that vision. Every SI payment then becomes a deliberate step towards a specific future you're building.
It really transforms saving from just a generic good habit into a purposeful action with a clear target in mind.
Okay, so we've figured out who we are as investors, step 1. We've set our destinations with clear goals, step 2. We've planned the route with tailored SIPs and asset allocation. What's the third crucial step the video calls decisive?
This is where the power of rebalancing comes in. And the video uses another great analogy here, comparing your investment portfolio to a garden you've planted.
Ah, yes, the garden analogy. You start with a plan, right? Maybe some sturdy roses here, some fragrant jasmine there, maybe some fast-growing basil.
Exactly. You have an intended mix, a balance. But, over time, nature happens. The basil might just spread like crazy and start taking over.
Here happens in my garden.
Right. The roses might struggle one season. The jasmine could get a bit overshadowed. That initial balance you wanted, it shifts. Rebalancing is the active process of going back in.
Pruning, adjusting.
Exactly. Restoring that intended balance to keep your garden healthy, controlled, and aligned with how you originally envisioned it.
Okay, so translating that to investing, what does portfolio rebalancing actually involve? What are we doing?
It means you started with a target asset allocation. Let's use that moderate example again.
Right.
Maybe 60% equity, 30% debt, 10% gold.
Okay.
But because of how the market's performed, let's say the equity market just soared, your actual portfolio might now be skewed. It might look more like, say, 75% equity, only 20% debt, and 5% gold.
Oh, okay. So your portfolio has actually become riskier than you intended, just through market movement, without you actively doing anything.
Precisely. You've unknowingly drifted into a higher risk exposure than your profile says you're comfortable with. Rebalancing is the process of systematically bringing that allocation back to your original target.
So in that example, you'd need to
sell some of what's grown too large in the equity in this case, and use that money to buy more of what's now underweight, like the debt and gold, to get back to that 60-30-10 mix.
Got it. So it's about intentionally managing risk over time, not just setting it once and forgetting it.
That's the key. So when should someone actually do this rebalancing? What are the triggers?
Good question.
The video suggests a few practical trigger points. A really common and effective one is just doing it annually. Schedule a portfolio review every 12 months. Think of it like a yearly checkup for your financial garden. Make adjustments then.
That feels manageable, a predictable routine.
It is. Another trigger is after major market moves. If the market has had a really significant swing, up or down, maybe by 20–25%, your asset allocation has almost certainly been thrown way off.
So that's a good time to reassess and probably rebalance.
Definitely. And logically, the video also mentions rebalancing when you're approaching a specific goal.
Ah, right. That makes sense too.
Absolutely crucial, this one. If that long-term goal, retirement, the house down payment is now only, say, 2 or 3 years away, you should be actively rebalancing.
How so?
By gradually shifting a larger portion of your portfolio out of those riskier assets like equity and into safer debt investments. You're protecting the capital you're going to need relatively soon from any unexpected market crashes.
Okay. How do you physically do the rebalancing? What are the mechanics?
The video offers a couple of main methods. One is to use your new investments or your ongoing SIPs.
Ah, so instead of spreading the new money evenly.
Right. You direct more, or maybe all, of your new SIP money towards the asset class that is currently underweight compared to your target.
So if my equity portion has shrunk below my 60% target, I'd maybe put my next few SIP payments mostly or entirely into equity funds until the balance gets closer.
Exactly. You use the incoming money to gently nudge the balance back.
Yeah.
The other main method is active buying and selling.
Okay.
This involves actually selling some of the asset class that's now overweight, like the equity in our earlier example, and using that cash to buy more of the asset class that's underweight, like debt or gold.
Now, the video did briefly mention considering taxes and charges here, right?
Yes, and that's a really important detail. Selling assets that have gone up in value, especially if you haven't held them for a long time, could trigger capital gains taxes.
Which could eat into the benefit of rebalancing.
It could, yeah. It's something to be aware of. This is why some investors prefer using new contributions for rebalancing when possible, as it avoids that immediate tax hit. But active buying and selling gives you more precise control to hit your target allocation right away.
So it's a trade-off to consider based on your situation.
Exactly. And the video also mentions that some investment products actually do this for you. Things like certain balanced funds or dynamic asset allocation funds offer auto rebalancing.
Oh, interesting.
Yeah, they automatically adjust the mix based on their own preset rules. That can simplify things, but you obviously need to understand how they do it and if it aligns with your needs.
Beyond just the mechanics, the math of it, the video really seemed to highlight that rebalancing has a big psychological benefit too.
Oh, it's huge. It's not just a mathematical exercise, it's a discipline. And it acts as a kind of psychological shield against emotional investing. Well, think about it. When markets are booming, everything's going up, your equity portion gets too big, right? Greed might tell you to let it ride, but rebalancing forces you to sell some of that winner.
Locking in some gains. Counteracting greed.
Exactly. And when markets crash and your equity portion shrinks, fear might scream at you to sell everything. But rebalancing prompts you to buy more of the now cheaper asset class.
Forcing you to buy low, basically. Counteracting fear.
Precisely. It instills a discipline that our natural emotional reactions, fear and greed, often fight against.
Okay, so summing up what this Value Vibe video lays out, it really seems to provide a clear step-by-step framework for turning investing from something maybe vague or even intimidating into a much more focused, deliberate path towards your actual goals.
It really boils it down to those three key actions, doesn't it?
Yeah.
First, gain that self-awareness, identify your risk profile.
Know thyself.
Right. Second, give your investments purpose, set specific financial goals, and then intelligently link them to your SIPs and your initial asset allocation.
Have a destination and a plan.
And third, maintain discipline and manage risk over the long haul by regularly, systematically rebalancing your portfolio. Don't just set it and forget it.
Tend the garden.
Tend the garden. And the video's concluding thought is pretty powerful, I think. It says the true winners in investing aren't necessarily the ones who pick the absolute best stock or fund every single time.
Which is impossible anyway.
Pretty much. But rather, the winners are those who approach it with understanding, who plan their growth diligently based on their own needs and profile, and who consistently adjust their strategy over time.
It really is the process and the discipline that seem to make the difference in the long run.
That's the message.
So if understanding your profile, nurturing your financial goals like that garden, and maintaining that balance through rebalancing can truly transform investing from maybe a game of chance into a clear, deliberate path to victory. Here's something for you, our listener, to think about this week. What specific personal dream, big or small, are you going to take the first step towards turning into a concrete financial goal, maybe starting today?